So we're joined by Timo Böhm, Senior Vice President, Portfolio Management at PIMCO Europe. Timo, how do you view the zero lower bound, the yield on covered bonds reaching a negative? Is it a deal killer for your investments?
Well, you know, there are, of course, a couple of discussions in between investors and real money clients, if and how and up to which extent it still makes sense to invest in covered bonds in a negative yielding world. But to tell you the truth, if you look at the statistics, 20 to 30% of new deals in the covered bond world are signed by real money investors, such as insurance companies or pension funds, and the remaining 70% are signed by central banks, by bank treasuries, by LCR style-driven investors. And here you can see that the covered bond world is mainly a world where investors come from the banking side, but on the other side, this 20 or 30% in participation is rather stable over the last year. So this didn't change over the last several years. So from that point of view, we see still stable demand from investors given the low level of yields. On the other point of view, if you are a real money investor, or if you are an active manager, what you are trying to do is you basically have a benchmark, and you are trying to provide value for your clients by managing the portfolio against this benchmark. And from that point of view, I would say that the absolute yield level, so and in our times the low yield level, is not that important. Yeah, because you have your benchmark, and independent of the absolute level of yields, you need to provide performance. And this is what we continue to do even in this negative yield environment. So we are trying to provide relative value by stressing the deals, by doing the correct credit selection, and obviously this has worked out. So if you look at the figures, the Bloomberg Covered Bond Index, just in this year, on a year-to-date basis, has an absolute return of over 4%. So this is a tremendous number in a low-yield environment. And this absolute return was also positive in 2018 and 2017 to a much lower extent, but we had still a positive absolute return. So, and this, from my perspective, is proof that you, even in a low-yield environment, you can still earn money with covered bonds. Of course, your question is, will this persist? And here's the big question mark. So we don't know, and of course, if it comes to real money investors, such as insurance companies or pension funds, they usually have quite long-dated, long-duration liabilities. We are talking about duration of over 20 years here, and they need to find investments to fulfill their liabilities. And from that point of view, it becomes difficult. So if such real money clients invest into negative yielding covered bonds, so covered bonds with a negative carry, then they need a firm tightening of spreads per year just to not losing money. Yeah. So, and this is very difficult for them. So what can they do? Okay, they can decide to move out the duration of the portfolio, but this just works to a lower extent because you have your portfolio structure, and to be honest, if you are a client with such long-dated liabilities, covered bonds with only 4, 5, 6 years duration might not be the most attractive investment. So what we see is that those clients already decided several years ago to structure their assets to other asset classes. So this is not a function of the low yield environment. On the other side, as I said before, these real money clients, they are looking for other investments such as real estate or alternative investments or private placement structured deals. Some might argue, okay, these kind of investments might include higher risks. Yep. or lower liquidity. This is true, but what I want to say is because everybody is looking for yield, and the central banks globally, not just the ECB, but the central banks globally bought assets in the last years which provided stable returns, which had a quite high rating. Because of the lack of those stable assets, everybody is looking for alternative investments, for real estate investments, and given this, there is a lack of these investments. Yeah. Hence, to make a long story short, so given the low yield environment, I certainly think that the investor demand in covered bonds will certainly not increase over the next time. But on the other side, I'm pretty sure that we won't see anything like a big escape out of the market. Yeah. So I'm sure this will be a rather smooth approach, and the market can change. And as we've seen it in the past, also investor demand in covered bonds, there can be ups and downs, and this will happen.
Of course. And finally, the covered bond directive is going to be implemented over the next couple of years. What will its long-term impact on the market be?
Well, first of all, so we were talking about this covered bonds directive about 50 years almost, and finally we got it. So it is a very good project. It's a project which can be seen as one way to get a sense of a European banking union, and there are several points which are of great importance. So the new directive makes sure there is a kind of public supervision of a covered bonds. Most important, there are rules which define the cover assets. There are rules which define how to deal with extendable covered bond trades, and last but not least, there are transparency rules included. This is all very positive, and we have to think about 2 points here. The first is, if you are asking about the impact, the first is the overall impact. The second is the pricing impact. Yeah. If we are talking about the overall impact, I would argue it is not the question of when the directive will be implemented. So you can see the impact quite today. So this harmonization can be seen like a firewall you have on your smartphone. You know, the low yield environment is an incentive for lots of issuers, originators to, let's say, to use other than the established assets for securitization. Yeah. So this, for us as an investor, was always a big concern. So what will happen? Will there kind of dilution of cover assets? Will there kind of increasing asset encumbrance? And from that point of view, given we have the harmonization right now, this is really kind of a firewall against those developments. The second point I mentioned, the price impact. Here I would say at the moment, risk premiums for different asset classes, for different degrees of risk are rather low. So maybe today harmonization does not play a minor role. So also an investment decision, I would argue it has just a minor role right now. But this can change. And if you see the implementation following 2021, who knows how the yield, the absolute market yield level will be. And if we see a rising risk premiums again, then in such a situation, the directive will pay off, because then people will recognize the different covered bonds, euro covered bonds, euro premium covered bonds, and then I'm sure that the harmonization can also be monetized.
Great. Timo, thank you very much.
Thank you.